Hi everyone, my name is Connie. I'm the Director of NZ International Tax and Property Advisors. Welcome to another video. In this video, we'll cover some tax issues a property investor may face when holding an overseas rental property. Just a little bit about myself. I'm a chartered accountant, property consultant, and ex-tax lecturer. I have more than 10 years of tax, accounting, and property experience from working in Big Four, mid-tier, small boutique chartered accountant firm, and with residential and commercial property investors with portfolio size ranging from 1 million to 10 million. We're a one-stop chartered accountant firm for tax, accounting, property consulting, and training services for property developers, property investors, SME, and migrants. We specialize in taxation on land transaction, cross-border taxation for migrants, IRD disputes, and small medium business tax and property consulting for tenants and landlords. Here's an illustration of the case study we'll discuss today. So the New Zealand taxpayer, who's a New Zealand tax resident, is holding an offshore rental property. So first point here is that New Zealand tax resident will be taxed on the New Zealand source and worldwide source income. So the foreign rental income needs to be reported in the New Zealand tax resident's tax return. If New Zealand has a double tax agreement with the relevant country, then they may have an impact on the outcome. Second point is that deduction can still be claimed in respect to the overseas rental income. Third point here is that the taxpayer can elect to return the foreign income in the New Zealand tax year in which the overseas balance date falls. So for instance, say if the rental property is in US and US has a standard balance date at 31st of December, this means that the US rental income derived, say, for the year ended 31st of December 19 can be reported in the New Zealand 2020 financial year. So that's year ended 31st of March 2020. This rule is available to taxpayers whose foreign income is less than $100,000, and that's in New Zealand dollars. Next point here is that the ring fencing of tax losses still applies to overseas residential properties. And so what this means is that the losses from this overseas residential property cannot be offset against other income aside from the future rental income or proceeds from future sale if the transaction is taxable. Next point here is that if the taxpayer borrowed funds to acquire the overseas property, then the loan may be it's likely to be subject to financial arrangement rules. So if the taxpayer is a cash basis person and certain criteria need to be met in order to be a cash basis person, then any unrealized foreign exchange gains and losses do not need to be brought to tax. Whereas if the taxpayer is not a cash basis person, then any unrealized foreign exchange gains and losses do need to be brought to tax. So it is on a case-by-case basis, and you need to have a look at your situation and see whether that applies or not. Also, a base price adjustment calculation is required when the loan is repaid or disposed of. And last point that I like to make here is that if the New Zealand borrower pays an interest payment to the foreign bank, non-resident withholding tax may apply. Again, that is on a case-by-case basis because there are exclusions. But if, say, non-resident withholding tax do apply, then we can look into whether approved issuer levy can be applied in that case, which can reduce the tax rate to 2%. If you've got any tax, accounting, or property queries, feel free to email me or call me on my mobile at 022-061-6521. If you're interested in getting more further tax, accounting, and property updates, make sure you subscribe to this channel so you aren't missing anything. And please hit the thumbs up if you find this video useful and helpful so that I'll know. And thanks very much for watching, and I'll see you in the next video.